Welcome to Just Think About It with Nadine and Ben. We are recording this episode on Sunday, October 27th. Before we start our conversation, we have two key requests. First, if you're enjoying our podcast, please subscribe via Apple, Spotify, X, YouTube, or your platform of choice, and make sure to hit the like button. Second, we appreciate any kind notes and feedback and would appreciate you letting your friends know where to find us. So today we're excited to connect with you, a seasoned investor who is wicked smart and successful, Tian Zeng. Tian started his career at Citigroup in structured credit and macro credit trading, where he was promoted to the head of the desk at age 26. So he subsequently ran trading desks at Citadel, Deutsche Bank, and Jefferies before leaving the sell side to launch Nirvana Capital Management to trade credit and macro. He also started Phoenix Digital, which specializes in special sit, event-driven, distressed opportunities in the crypto space. And we're excited to call him a friend as well and to dive into the various macro markets with him today. Welcome, Tian.
Thanks for having me, guys. Appreciate it.
Good to see you, buddy.
But before we dive in, I know we have a lot of questions we're going to pepper you with here. Ben and I were hoping to discuss your background a little bit, the evolution from the sell side to the buy side, because I think a lot of people are always asking how to do it. Should they do it? What is it like? And I think that'll help provide also a background for our discussion today when we get into the details of investment strategy and certain trades or other opportunities that you're seeing.
Yeah, sure. I mean, I follow the pretty structured path for Wall Street, which is, I interned at Citigroup in the summer of '09, which was quite interesting. And then I was able to fortunately get a full-time offer to come back after graduation. And so I did just that. It came to New York in 2010, started my career at Citigroup. It was like a good training ground for those that want to learn the intricacies of trading on Wall Street. I started in structured credit right around 2010. So post-crisis, trading mortgage-backed CDOs. So all those guys in the movie, the book, Big Short, were, essentially my counterparties and clients. On the sell side, most importantly, it's the relationship that you cultivate over the years. And that's how you really expand the network. Clients, when I was a market maker on the sell side, are still friends and still doing business in some format. In fact, one of my clients, when I was a market maker, anchored me in my crypto fund. So that just goes to show like the relationship really matters in addition to all things that you learn on the job. So, and then in terms of moving on to the buy side, it's really, for me at least personally, it's about being on the sell side for so long and having learned everything that I could, at least in the products that I traded. I felt like I hit a plateau and in both learning new things, but also the people that I interacted with. So,
and why is that, do you think? What is it that you felt like you couldn't get from there that you could get elsewhere?
Yeah. So on the sell side, typically you're like a market maker for one product, right?
Yeah.
You're like the master of that product. You're ideally, a top 3 on the street in that specific thing. Let's say S&P options, right? That's your product. You trade that all day, but that's it. But then it gets repetitive and redundant. And so for me, I like new challenges, learning new things, meeting new people. I think my buy side experience so far is a little different than most others, where I think the leap is typically to a pot shop or a established hedge fund that has infrastructure and people. For me, it was more like an entrepreneurial endeavor where I had to create the firm. I had to raise the money, and then once I raised money, I have to still perform and generate P&L for my investors. But this whole process is very rewarding because I'm building something. I'm really meeting new people as I create and become like who I want to become. And so I sense the self-development and fulfillment in that process, less so about like destination, which is, we all know we have to make money for the LPs, but I got to meet you guys, for example, like that's, that makes me really happy. So yeah, that's kind of like how I look at sell side and buy side and my personal perspective.
So now I want to move you to Nirvana. And so now you're on the buy side for both the traditional finance fund as well as your crypto strategy. So maybe you could walk the listeners through what your strategy is, some of the ways you execute that strategy, again, so they have a little bit more background before we get into more detailed questions.
Yeah, sure. So Phoenix Digital actually came before Nirvana.
Okay.
Because essentially I left the street originally to manage my own capital in October 2022. And 2 weeks later, FTX goes under, and that's where I was trading most of my
Sorry to
crypto.
laugh. I didn't mean to laugh. Just I think we've all been there in bad timing, right? Or good timing,
Yeah,
if you want to say, for that you have opportunities, right?
it was terrible, but at the same time, I was actually not as upset just because like worse things have happened to me. And it was like, you know, um, a lot of it was half my net worth, but I started almost at zero when I first created that account. So to me, I wasn't really that upset. I just spent a week trying to figure out the assets and liabilities in the FTX entities, had to piece them together because they didn't have financial statements.
Right.
And really came to the conclusion that, the net asset value for FTX customer creditors, and had to make assumptions where customer creditors were senior secured and they get paid before everyone else. Customer creditors were worth like 70 cents on the dollar, but in the claims market, it was trading at 5 cents on the dollar. So I actually created Phoenix Digital to buy FTX claims.
Okay.
In the very beginning. It was hard to raise money at first. It was bottom of the bear market.
Sure.
In crypto. Bitcoin was 17,000. Claims were trading at 5 cents. So it took me 3 months to really raise the capital. But like I said before, one of my former customers, a structured credit hedge fund, anchored me in this trade. So ultimately I started buying these claims starting at 20 cents on the dollar. I had to buy it up just because it's been like a one-way trade. Now, it's been a great trade, but that's how I got started in Phoenix Digital. And of
where
course,
are those now? Where are those claims at now?
Yeah.
So the claims now trade at 120 cents on the dollar or so, and the expected payout for anything above $50,000 is about 144%. I think it could get a little higher than that. It could be like 150, 160%.
Great trade.
Ultimately, but yeah, and it's still a great trade right now if you buy them at like 110, 120, because you essentially get a first distribution, hopefully in 2 to 3 months from today. And that distribution is expected to be something like par. So if you pay 120 today, you get par back in 2 months. You're essentially paying 20 cents to get another 30 cents or so, and over the next 2 years. So in terms of IRR, it's still a great trade.
Yeah.
They already have 12.5 billion cash on the balance sheet, and they only have to pay. They got about 16 billion assets. For creditors, liabilities about 8.5 billion. Alameda's 1.5, and so, yeah, that's why I think there's 160% recovery. Now this is at petition day value, meaning if you had Bitcoin at 17,000, if you have Bitcoin, it's marked at 17,000 on petition day value. So you're not really getting everything back. If you had crypto, that appreciated. Now you could have had crypto that depreciated as well, but there's some arguments from some customer creditors that's still point of contention. So that's how I got started with Phoenix Digital. But in the meantime, when I was buying these claims, I was also in discussion with a couple of fund of funds that wanted to look at my TradFi bread and butter strategy, which is really a strategy called macro credit. Macro credit is really trading macro from a top-down approach. But unlike the old school macro guys that trade a ton of rates, FX, and commodities, in macro credit, we trade a lot of credit. We trade a lot of equities. And the credit that we trade isn't really single name credit. We trade a lot of indices like high yield index, IG index, in the US, when there's like those indices in Europe. And then we trade options on these indices. We trade tranches, trade total return swaps. These are synthetic indices mostly, so, or also known as swaps. So credit default swaps is the Delta One instrument, where it's an index of these credit default swaps. Just like S&P 500, you got 500 companies. High yield CDX is 100 companies. IG is 125. And so we essentially trade S&P and NASDAQ and IWM of credit in synthetic format because they're credit default swaps. And then we trade the swaptions that, just like in rates, you have swaptions, we have credit swaptions as well. And then tranches is essentially a structured credit trade where you take one Delta One product and slice into different pieces with different cash flow waterfalls. And then on top of that, we trade a lot of equity vol. A lot of it's really RV versus credit vol, and whether that's swaption in credit default swaps or the equity format, which is like, HYG ETF, LQD ETF. Those are the equity exchange listed equivalents in credit, but those have more rate risk. You have to, hedge out some of the rate risk. So then we trade a little bit of rates as well, because then we take rates views on, are we trading the all-in yield? Are we trading the credit spread? So that's what, in a nutshell, what macro credit is, and sort of the bread and butter strategy of the current strategy at Nirvana as it is being paid.
Got it.
And is that mostly you're taking views on the direction, or is there arbitrage opportunities, or is it you're saying, hey, I'm trading the relative vol, or I think vol's going to expand or compress? Walk through like what a view would like, then how it would be expressed.
Yeah, it's a bit of both. We start looking at the markets from an RV perspective. Imagine you have like an empty book. We tend to just look at RV first and see what is rich, what's cheap, and we have models that determine that in the matrix of products that we trade. So now we put on, like, say, one or two RV trades where, we think S&P's too rich to high yield credit. And so then we go and buy high yield credit versus shorting equities on a beta adjusted basis. Let's say on a delta neutral basis where our regression model says this is the beta, and we put that trade on. Long high yield short equities is actually a bearish trade, just because you actually get carry, positive carry, and then you have, beta picks up on equities on the downside. So typically that's a bearish trade. That's an example of an RV trade. And then we can do RV in vol as well, like high yield vol or IG vol versus S&P vol or IWM vol. So,
and Tian, when you're doing this, sorry, I'm going to interrupt you because I'm bad at that. Is that you're laughing, Ben? So do you come up with a thesis that you think something's going to happen, and then you're looking for asymmetric opportunities given the products, the securities that you trade, how to reflect that thesis? Or maybe walk through mentally for people listening, like, how do you go about deciding what to trade when? Is it like thesis driven, or is it, you've got your macro thesis, then you come up with it? Or are you scouting certain things and then you're seeing where asymmetries are, and then are you choosing like the most asymmetric bets? Just a little bit more background on that.
Yeah, absolutely. So, we look at everything from top down. So we'll formulate macro views.
Mm-hmm.
And then, as we put on these RV trades, we ask ourselves, like, does this trade perform if the thesis is correct? Like, how does it perform? Why does it perform? And to your point about convexity, we like to own convexity. We like to, especially at this point in the market cycle, we like to own convexity because corporate spreads are at post GFC tights for the most part, cash and synthetics. And in credit, you have spread convexity. Spread convexity just means you have IG 5-year on the run 5-year trades at 50 basis points, for example. And spreads, unlike equities, spreads can only go to zero. You have defined loss on the upside when in a bull market, right? Equities can go to infinity technically. So you have spread convexity, and of course, spreads can't really go to zero, and corporates,
right.
I mean, we've seen governments, never say never, but like European government bonds have gone into zero spread, negative spread, but it's really hard for corporates to go into negative spread, right? Because, versus can't do QE and et cetera. But, so you essentially have this wall of negative spread convexity.
Mm-hmm.
But if you do short the spread, you do pay a carry. So there's no free lunch. You have to pay a carry that's pretty negative, and then you're just losing money every day if the spread doesn't widen. And so that's an example of the basic delta one spread convexity. But of course, there's like options. There's ways where you can structure a trade where in sports betting terms, you're like to put down $1 and make 3, 4, 5, maybe 10, and not put down $5 or $10 to make 1. A lot of people do that. That's, vol selling strategies exist and it's very prevalent. They put down 5 to make 1, and they make the $1 in many instances. But that one time you put down 5, or you put down 100 to make 1, you lose 100.
Right.
So every couple of years,
well, right? Like the guys who do that, the vol sellers are using a lot of leverage, which is, and when we see that, like, for example, we've been talking all year, we saw in August, and July into August is a good example of guys running these trades, putting down $5, $10 to make a quarter. It got so bad, and then it just unwinds, right?
Yeah. It's one of those things where it's also the structure of the market where you have pot shops that is becoming a bigger and bigger part of the market participant base. So, and selling vol is easier in these strategies than to buy vol, right? Think about a world where really most days nothing bad happens or nothing big happens that causes, realized moves. So as a pot shop, you're supposed to sell vol, and you collect money every day, right? But because it's so crowded and these pot shops have vol control or VAR control or some sort of risk management in place, that in like 1 or 2 standard deviation moves, realized moves, they start cut, and the risk manager starts telling people to cut, right? So then that exacerbates the move as well. But for us, we like to own these sort of type of convexity just because, like, typically the structure of the market is that people are sort of on one side of the boat, and the boat's tilted. So,
and these guys, so in essence, they're short vol, and they're making money within, let's call it 60, 70% of the time. Let's just say 1 standard deviation of the distribution, which forget about the normal part of it, just to make it an easy conversation. But then they're exposed to the skew then is basically what their risk comes in, right? That's where they can get, if I'm short a stock and long a stock, just as a simple example, I'm actually have 2 bets on, right? I have 2 bets on, and then I'm also short liquidity. So, skew being like a way to think about like, oh, that's when liquidity really blows out. That's when these guys get hurt in essence, right? And here's what you're saying is they rapidly take their bets, not their bets, but their gross of their book down at the same time in essence.
Yeah. So a lot of people sell vol outright. Some people will do it via like outright, meaning let me sell some puts straight up, maybe even no delta, right? Some people will sell it with delta, and that's the original format of selling vol. Sell put versus delta. Excuse me. And some people will like sort of hide a little bit the vol selling by selling like a put spread. So I'll sell a S&P down 5% put, but I'll buy a S&P down 10% put just to protect myself in case S&P blows through the 5%, down 10%, 20%, I'm protected. And that looks great to the risk manager as well. But that's, a lot of that is selling skew. And there's more complicated ways to sell skew as well, where you buy gamma and sell vega. That's a very, a lot of people, hide part of the vol selling in that kind of setup and really get crushed when the market's down a lot very quickly. The vega gets marked up very fast, and like COVID, for example, that's a typical. That is a great example of when short skew gets really smoked, because you are short a lot of the very low delta optionalities. that picks up 100% delta in like 2 days. And so that exacerbates the whole move. But hey, last year and a half, selling Skew has worked perfectly. Even in August, short Skew wouldn't have really lost that much money because everyone wants to buy the dip. And so when, market blows out very quickly, even in August, as fast as it happened in August, you guys have these hedgers come in and monetize, right? They monetize,
Right.
and then so your Vega doesn't move, and you actually lose money in some cases. So really depends on the regime, but that's kind of like how we look at things. We like to own Convexity for those reasons.
So what do you think when we look at the market today? What do you think the most attractive, like asymmetric bet is that you're seeing right now?
So right now, credit offers the most asymmetric returns on the downside and the least amount on the upside. Like I said before, just from a spread perspective, if a range of spreads, multi-year range of IG is 50 and 150, and it's sitting at 50, and it can only go to zero, it's never gone to zero, it shouldn't really go to zero or anywhere close to zero, then that's like perfectly, sensical to own downside in credit. There are reasons why it doesn't move and doesn't widen, why it's here. A lot of it has to do with, inflows and fund flows, but more specifically inflows into fixed income credits as the Fed is cutting or expected to cut. So all this money coming in to real money investors, and typically these real money investors are all-in yield buyers. All-in yield buyers means they buy the whole entire credit without hedging the rates. So IG corporate typically has two components, a spread component and a treasury component, right? The treasury component is like 80% of the overall all-in yield. So they see all-in yield at 6%, 7%. And so they're like, yeah, sure, I'll buy that. But in reality, 5% of that 6-7% yield is treasuries. So you're taking on a lot more credit risk and very tight spreads. But that's a big force that's driving spreads tighter and tighter. And of course, we haven't seen that many defaults in this cycle as firms are able to refi. This credit is here, for a reason as well. But if you look at the cross asset relationship, almost all the other assets have repriced this year. The highest risk premium asset class is really rates vol, but that's been sort of high for 2 years, almost 3 years since the Fed started hiking from zero. So rates vol, if you just look at move index, is very, very representative of that. In fact, we're at year-to-date highs in the move index just because policy uncertainty from the Fed, but also the election noise from who's getting elected. In this case, Trump, taking a lead, and then that could be very bad for both the long end and the short end. So the move index is reflecting that, but it's trading at very high premium. It's trading as if the equity VIX is at 30 to 40. Speaking of the VIX, it's like anywhere between 18 to 22 in the last couple of weeks. Part of it is the extra premium for the election, but at the same time, if you look at the VIX curve, it's pretty flat. So it's not like, we're at 20 for November and then it's downward sloping, but it's actually really flat VIX curve. And that's also the case for other asset classes like FX vol. But, equities is really pricing in more risk premium going forward.
So Tian, can I ask you a question?
Yeah.
So this is more of like an on-the-fly question. So let's say somebody's listening here and their wealth manager put them into some corporates because they gave them the same spiel that, look, you can make 6.5% on whatever bank or, steady Eddie company that they talk about. It's good credit. Don't worry about the credit. So now they've got this portfolio of investment grade bonds. What do they do currently, so that, like you're saying, if a lot of that yield's actually coming from the treasury and it's not the spread, what do they do to protect themselves if they already have money out? Because lots of times people get sold things, but maybe they don't understand really the risks that they're taking that you're talking about here.
Yeah, so I think IG all-in yield's fine. I think just because it's less prone to default risk, and if you have a big risk off, treasuries rally, and so then IG actually rallies.
Yeah.
But where it's more dangerous is really high yield, because default rates pick up, and then that's where you can really have realized losses from defaults. But one way to protect is buying options.
Mm-hmm.
You can always be very long and buying options. And that's what people are doing this year. They're not really selling their longs in big sell-offs or big vol events because they want to buy the dip. They don't want to sell. So then they'll buy these like 10 delta options and say that they have, downside protection. And of course, market has some sort of vol episode. Then they monetize these hedges. And that's why we see these we've had 3 episodes of vol events this year. April growth scare, June sort of more so in Europe with the French elections, and August we had, the cherry on wine. All 3 highs were very much V-shaped recoveries in both the market and even in the bull market. So yeah, I think options is one way to protect it, but also there are some, structural reasons why just owning outright IG is is a hedge in itself, because it's 80% rates. And so the only way for IG credit to get smoked is if we have a big inflation pickup again. If CPI goes to 5%, all of a sudden the Fed has to hike very quickly. All of a sudden, or something like scenario where Trump's tariffs become very inflationary, the long end gets really smoked, right? Let's say 100 to 200 basis points in a month. And that's the lot in a very short period of time. Then that is really bad for credit. Actually, 2 scenarios. This is the first scenario where rates move a lot. The yields move higher a lot in a short period of time. This means all-in yield buyers are afraid to buy the dip on these all-in yield. As all-in yield gets better and better, because their existing portfolio is down a lot mark to market. It's every day it's smoke. You're not buying the dip, right? If it's a slow, gradual process of 100, 200 basis points over a year, I think people buy a dip because they don't see this big mark to market in the portfolio, right? And you have these banks that hold these securities, especially regional banks, but they're going to have a huge, non-mark to market loss as well, and they can't lend. So this scenario is really bad for credit, especially IG. The other scenario is bad for credit that, yes, in risk off, I guess you get Fed potentially cutting, and then, yield goes down. It's good for IG. But if it happens too fast as well and too much as well, let's say the Fed cuts to 0, all of a sudden your credit spread is tiny. And so then you have no treasury component.
Yeah.
And then all of a sudden you're stuck with a potentially a 1% yield IG bond. So what do you do? Everyone will sell it. So those are scenarios where it's kind of bad for credit.
But then as a guy who's a market maker in credit, think about the order of operations. When you typically see an event, what you see is there's a dash for the high quality collateral, which is treasuries. Although you could question, as they've blown out so much, the supply is much greater than it was. And then credit spreads will widen, right? And then basically you're not really getting any of the appreciation on that treasury because of the credit spread widening, right?
Yep. Depends on how much they widen versus the treasuries, but typically you can think of credit spreads, let's say a benchmark 10-year IG spread, as the VIX of credit. And in the Merton model and various data equity models, the credit is a put option on the firm's assets. And so it's almost like vega or tail in a way, if you think about it. If something bad, but not bad happens, like credit doesn't care. But if something really bad happens, then credit will underperform the most because it's a tail option on the firm's assets. And so a good example of that is the SVB crisis in March of last year, where all these banks started going under, right? Equity came off. It's risk-off event. I think S&P was down maybe 5%, but credit sold off as if S&P was down 15%, like in beta adjusted terms. So when there's default risk and credit risk, that perceived credit risk as being in jeopardy, that's when credit gets picks up a lot more beta.
Right. And so in this current environment, there's a guy I talked to who's a high yield long only manager. And he kind of made the argument that one of the things that's kept this credit where it is one, swap spreads are kind of negative. Two, for the synthetics. Two is that, like you said, that there's a lot of flows in, but there hasn't been much supply growth. And then within that, CLOs have taken some share.
Oh yeah, 100%. So you have fund flows just from mutual funds or 401ks or that will come in the market to get the yield. Then you have coupons being paid on these credit, right? It's quarterly payment on most bonds. So you get like cash coming in, like a dividend. Then you have to reinvest it. And at the same time, there's not enough supply. There's a lot of supply in terms of like versus last year or versus like, it's still record highs for IG issuance, but not as much for high yield. High yield issuance is not as big, just like how somehow we don't have a lot of IPOs right now. But on top of that, you got, so there's this supply demand dynamic is why it's in play, and why people have to chase. And there's just so much money in the market, because the Fed printed so much money. The balance sheet came off a lot, but it's still, quite high. The Fed hiked rates, but they still kept the money circulation system. So there's a ton of cash. And so that cash is going after CLOs. The CLOs is also buying all the loans in the market. And then you got a new dynamic, not new, but like a dynamic that's very much in play, and that's private credit. And so a lot of money going after private credit, where it's like, P2P lending almost. So yeah, the structure of the market is such that, money flows really matter.
And then private credit, what's your view on that? We've talked to a few people on that. And it seems like it's not super transparent. Does seem like less leverage than banks. If you're thinking about assets to equity ratio, even though they use some leverage, maybe it's systemically safer. Do you think that you'll continue to see growth in private credit as we go forward?
Yeah, the growth is not because it's much safer. I would argue it's less safer for a lot of reasons, but the reason why it has a lot of growth is it doesn't have mark-to-market.
Right.
Investors love that. If you invest in something, in 3 years you get like 40% return, like, and you're never down money, like on a daily, weekly, monthly basis. Like, I bet you during COVID, a lot of the guys didn't mark their book down too. We had a lot of discussions during COVID about this too, where, a lot of BDCs were not trading at the right, even at, now they say they have, it's not marked correctly. Private credit has that shine because investors don't have to work, they sleep better. But the quality is worse because in reality, I would argue that the CLOs bought all the higher quality stuff, and what's left gets pushed over to private credit. And that's why the yield's much higher. In private credit, it could be anywhere from 12 to 18%, 20%.
It's like an equity, though, right? It has to be higher. I mean, right? The bank can use that leverage so they can accept and they have a lower cost of funding, right? If I'm a private credit investor, I'm like, hey, I'll give you this, but I want 10% or 12% or something. I don't want 6 or 7.
Yeah, absolutely. So, a lot of these firms, the borrowers are smaller borrowers. But you have to ask the question, like, if it's a smaller firm and they're borrowing at 15% a year, are they going to, are they going to survive? Are they going to do well? Are they going to pay you back?
Right.
So I guess my view would be, sorry, but just like basically from a systemic point of view, it's safer, but on an individual credit, the credit quality is much lower, right? Is that fair to say?
That's just like CLOs too. CLO picking, a lot of the CLO picking skill set is identifying the manager that actually buys all the loans into the CLO, especially when you buy equity tranche of the CLO.
Yeah.
But the manager matters a lot. And so it's credit selection, and it's the same case in private credit. Like, who's originating, who's doing the due diligence. I think that really matters.
And have you noticed on the specialty lenders, some of the publicly traded ones like Blue Owl, for example, the percentage of their income that's PIK income is rising? And
there's a lot of guys that want to short these publicly traded private credit lenders, especially into a downturn, right? These guys have a ton of exposure but the PIK, I would say, and just to be clear, like, PIK is when the firm can't pay the coupon, but it accruals onto the principal, and they'll pay at the end if they don't default. So, there's a rise, but, triple Cs have done really well the last 3 months. If you look at triple Cs, they've rallied 20%, 25% in the last quarter. And now they're like, I think, 4 or 5% of the overall high yield market, which is at the lows as a percentage of the high yield market. It was about 10, 12% 3, 4, 5, 6 months ago. So triple Cs have done really well, despite, PIK bonds that are picking going up. It's never a good sign when that happens, but, generally triple Cs have done okay in the last couple of months.
Yeah. So are we thinking then, if we look back to COVID, we have this event where the government starts really running deficits. I guess it started with Trump with tax cuts, but it accelerated in the last 4 years, call it, right? And I was looking at the data this weekend. And so in that environment, private securities, whether it's equity or credit, especially if there's not enough supply, to your point, just get bid up, right? And then in essence, the government's sort of underwriting the cash flows in a way. Like, there's the hurts and the dishes, so there is still bankruptcies and stuff. But in that, and maybe is that where the complacency comes from? That everyone just kind of like, hey, the government's underwriting us, and we're going to just reach for the extra yield.
Yeah, this becomes a much bigger macro topic, right? And we had this discussion between us privately about deficit spending, which is, it's really driving everything. It's driving EPS, arguably driving commodity demand, especially gold demand. But now you have, commodities starting to bottom, and it's, look, it's at the end of the day, we are where we are because of deficit spending. Because
can you thread that for people on gold? Because you kind of went into gold, then came out of gold here with your point, but maybe connect the dots for people as you discuss your point on gold. Is like, why did that affect gold?
Yeah, for all, deficit spending is just in a way printing money as well.
Right.
So, how do you pay back your creditors if your deficit grows? And especially grows faster than your nominal GDP growth. Mm-hmm. And so then your interest expense grows bigger, and you have to, just like a person who has a credit card and starts borrowing money on the credit card at high interest rates, and you keep stacking up, your credit card bill, and your interest will grow as well, assuming that your salary or income doesn't grow as fast. So gold is a great candidate to offset the nominal growth of not just GDP, but nominal growth of EPS, right? So if you think about S&P, this year is up 22-3%, gold's up almost 40%. But so S&P and gold denominated in gold is down this year, technically. So everything's driven by this deficit spending, which starts at the top with credit and, everyone's piling into credit. Then everyone piling into equities.
Right.
And we see that because it's markets at, this is the best election year since the 1930s.
Cool.
We've had S&P's up 11 out of the last 12 months, I think. And then now people are piling into, or have been in gold, trying to chase it with silver and palladium, and then base metals as China comes out of its recession. So, and the victim here is treasuries.
Mm-hmm.
That's why 10-year can go to 6%, because that is where the losses going to come from.
Yeah. And so what's your current view on gold? I know you were short gold a few times this year. Where do you stand given the fact that we've hit all-time highs, and I think it's on the cover of every newsletter every day.
Yeah, so a lot
and
of those
crypto
shorts
too, but anyways.
Yeah, so shorts were pretty tactical, but in terms of the overall picture of gold, I think longer term it has a lot of upside. But it's gotten to a point where a correlation started to break down, the jaws started to open, because gold's supposed to correlate with rates, right?
Right.
And dollars. And you can see that, for example, yields have climbed, 10-year has climbed 60 basis points or more since the Fed cut 50 in the last FOMC meeting. So your real yield's gone up. Typically, gold doesn't pay a coupon, right? Gold's negative carry because of the carrying cost of storing gold. Doesn't pay you a dividend or coupon. So the higher the real yield, the less attractive gold is.
Mm-hmm.
So you can't tell me
makes sense.
10-year went up 60 basis points and gold's actually up about 6% since the last FOMC meeting. Part of it's like the demand for, risk off assets that do well when Israel bombs Iran or something bad happens. But in reality, gold's still a risk on trade to me. And so at some point, I think that jaw should close. It might need a catalyst. Sometimes it might not need a catalyst, where the dollar's rebounded as well. The Dixie's up, right? And it might go even higher if Trump is in office. So I think gold will have a correction soon. And it's not the 2%, it's probably the 5 to 10%. Right. But if it's down 10, you're supposed to buy it.
Right.
So it's kind of like, because you see that in Skew. And gold Skew is so inverted that you could really hedge your gold long, not by selling, but you can sell like a 1-year call, buy a 1-year put, and either collect a lot of premium, or you can sell like up 20% and buy down 5% with costless, right?
Yeah, I have that actually.
Right, that's a great trade. That's a great hedge. Yeah. That's a great hedge. Down 5%. Down 5% is 3 weeks ago. So and then you see people chasing silver because they missed out on gold. You see people chasing palladium because they missed out on gold. So those behaviors are sort of like why I think
following it, right?
Yeah, those are beta plays to it, right? But I mean, we had our friend Rupert on, and he made a good point that one of the things about gold is that the biggest buyers of gold are central banks. So we've seen central banks as the major buyer of the market this year, from people kind of diversifying their reserves. And there's obviously the BRICS, and there's some multipolar arguments and all that. But in the U.S., and if you look at the GLD vault data, there hasn't really been the demand. I know it's starting to pick up as we get 2,800, and Costco selling gold coins. But for most of the year, it's been driven by foreign demand rather than investor demand. And it's broke its relationship with real rates.
Yeah. I mean, GLD assets actually went down as gold rallied. Now it's rebuilding. It didn't go down that much, but it went down as price moved up. So you wonder who else is buying. But yeah, like China and Russia, has been buying a lot of gold, and Saudi Arabia too. And those are like, essentially the big boys of the BRIC countries. And it's because, we confiscated,
their assets.
dollar assets from Russia that they own.
Relationships broke. Yeah.
Yeah.
Exactly.
So treasuries, not really treasuries, are not risk-free if it's owned by like someone else that you don't like. So they've been diversifying to gold pretty aggressively. And I think gold really rallied the last few days into the BRIC summit. But the summit didn't really come out with anything that says, yeah, we're going to denominate ourselves in gold. We're going to trade in gold. I think they're just going to trade in RMB, actually. They are already trading RMB. They trade oil in RMB. They trade, a lot of other stuff in RMB. Yeah. Demand is definitely coming from central banks, but the danger here is also they slow down or stop.
Fair.
Yeah, of course. Well, I mean, it looks like to me that let's just like imagine for a second, right? So everybody and their mother is now Stan Druckenmiller and Paul Tudor Jones are coming on TV saying, hey, we're shorting bonds. Gold's at the all-time high. Credit spreads are at the all-time, or the GFC tights, and the S&P's at the all-time high. So it's like, it seems like this is all one-sided, and it feels like a lot of people are on the same side of the boat. Now, let's just imagine Trump comes in and actually cuts costs. And I don't know if you guys saw, but the French government announced they're going to be cutting some costs. So what if we go, and the big surprise is that maybe we won't have the same kind of deficit spending, and that would be what you could get all these jaws to reverse in essence.
Yeah, so I think that will happen because that's Elon's dream, right? He wants to create Doge, but I think it stands for something like Department of
Government Efficiency.
Right. So he wants to cut all the fat in the government, which is
There's
a
a lot.
noble cause, and it should be done because I grew up in the DC area. I know how that can be, a weighs on the government efficiency of it. And we know in our daily interactions with government departments, it's very inefficient. But that is tiny compared to, let's say, Trump's policies. Let me cut taxes for everybody. He's offering no tax for everybody at this point, essentially. Okay, so if that happens, let's say that happens or something close to that happens, it doesn't matter if you cut $50 billion from the government.
Yeah.
So, that's why I think, rates can really jump if there's a red sweep, like really jump. I mean, you can see 10-year at 6%, and then the Fed's going to have a big problem because, not only the back end is in trouble, but, it's inflationary in many respects. You cut taxes, people have more money to spend, and then then each fibrous tariffs. The Fed can't cut in the front end.
Yeah, so that our friend, we had a guy named George Robertson on here, and he argued that the risk-free rate is really closer 5.5 to 6. If you look at what the mortgage market is pricing in, and the banks are saying, hey, so there's no term premium on the 10-year. So if we were to go there, you have Bank of America with their $110 billion of unrealized losses, and some other guys who, the banking system has $500, $600 billion. It's actually, that's where the real risk is to the system, right? The recessions, maybe credit will get hit and things, but that is the way that it goes where you really could have some problems, I think.
Yeah, definitely. I mean, there's if risk free is at 6%, we're in trouble. Yeah.
It's also pro-cyclical, right? One of the things I was doing this weekend, I think that when you get into these really heavy debt loads from the government and then deficit spending, people have to remember that it's two sides to debt. It's somebody else's income, right? So if you look at monetary income in the country, it went from 3 trillion in 2020, it's now 6 trillion. So there's a lot of people, Nadine's clients, a lot of people, my father has an RIA business. They're loving sitting there. Warren Buffett has $300 billion of cash. He's getting 5.25. So they really need to figure out a way to get rates down, but they can't do that with the deficit continuing to spend, right?
Yeah, there's definitely speculations as to why rate hikes don't work because you're essentially paying people more on their deposits and cash that people have more cash and, it doesn't really deter them from doing business or, from business activities. So yeah, I mean, look, if let's just, hypothetically say that the Fed hikes risk-free to 20%. Yeah, if I have $10 million and I get paid 6% on it every year, 20% on it every year, yeah, like I'm not struggling, right? Even on $1 million, like you pay 20% a year in interest from the government.
Why wouldn't you take it?
Not distressed.
Right. And that doesn't crowd out the rest of the credit formation. But again, the banks can't handle that. Like
Right.
there's a disaster for the banks.
Yep.
And so, okay, then now one last thing and then we can move on. What do you think? Some people have talked about, being long mortgages and then being short the credit spreads. Like, what do you think of that?
That's a very good trade in a lot of different regimes over the past 14 years since GFC. Yeah, basically, it's usually expressed through IGs versus TBAs. And I'd have to look at, because I don't trade a lot of TBAs, but people track that relationship. So if it blows out, there's like fundamental reasons why that spread should come in. Like that's a decent trade. I've seen people make a lot of money on that trade. And especially with IG at the tights, you're not going to lose much. You just have to think about if TBAs can blow out. That spreads, I know agency spreads have come in though over the last 2 years. My anchor investment, my crypto fund trades a lot of agencies. That spread has come in a lot. So it's not super obvious, but obviously corporates come in a lot too. Really depends on maybe at this point, if you put on that trade, it's your view on TBAs because corporates can't go much tighter.
Right.
Can I move you to the upcoming election, Tian? Yeah. So we've got that coming up here. And what do you think market positioning is for the election? And are you positioning into it or what are you doing around that event?
Right. So
I guess could be series events depending on if we have a result or a delayed result.
Right. Well, I think we have a delayed result unless Trump wins Pennsylvania, Michigan, and Wisconsin definitively.
Mm-hmm.
And I don't know if it's 1 week delay or 1 month delay.
Right.
Obviously, the longer the delay, the worse it is for risk markets. But obviously, Trump is leading right now in both prediction markets and polls. But in polls, it's much closer than what the prediction market is indicating. So on poly market, it's 65-35, right? That's almost 3-1 odds for Trump. Right. I don't think she's 3-1 odds.
Yeah.
In swing state polls, they're pretty tied up. Like in the most high quality polls, I'm talking about you exclude the outliers, and then you may exclude some like right leaning and left leaning pollsters. There's like 3 to 4 pollsters that are like very centered and very,
data driven.
Yeah, very pristine data. So not to say that they're going to be ultimately correct. We've seen a lot of polls being wrong, but they're pretty tied up. I mean, Trump caught up a lot in those swing states over the last month or so. And the margin error is plus minus 35%. So like, but obviously Ben and I had this conversation and it boils down to, do you think Trump underpolls? And, he definitively underpolled massively in 2016, right? Mm-hmm. Hillary was very much in the lead and lost. I don't think he underpolled that much in 2020. I think he underpolled in certain swing states like Pennsylvania that gets used as an example of why he underpolls consistently. But in reality, overall, he didn't underpoll that much in 2020. And then you have this question of, does Kamala actually underpoll? Because people are afraid to say that they vote for her because she can be perceived as someone that's not like
ready or whatever.
Such a great leader like Obama was. So people might be afraid to say, I'm voting for Kamala. And then you got, kids that couldn't vote back in 2016 to 2020 that are now able to vote. And typically that population leans very left. I think it's just going to be very close. And so you see that sort of in some of the Trump trades. They're up. Mm-hmm. They're not like crushing it. Like GL's not up that much. Like Fannie's not up that much, right? So, and even index vol has come off. It's pricing like, I think 1.4% move on election night, but it was pricing 2.3% at one point. It's come off a lot. VIX has come off a lot. As for me, I have positions where I think, credit just can't go any higher, whatever's in the office. So you can be short credit, you can buy calls on IWM. If Trump gets elected, IWM's underpriced. It can go up 10%. And we saw that in 2016. IWM went up, I think 8% in November. And then 2017 was, like a very good year for equities, especially IWM small caps. So you can
argue that some of that was because Hillary was minus 575 the day of the election. So the market was not pricing in Trump. And then remember, we got that 100-point sell-off that night, and then just a buying parade for the rest of the year.
Yeah. So that's definitely a part of it. Yeah.
You think there's a sell the news? Like if Trump wins, and let's just say Trump wins, and it's not the non-contested things, obviously a very negative scenario, and you just have to look back at 2000 with Bush and Gore, and you saw that it sold the rest of the year, right? So in the non-contest or in the contested issue that the longer it lasted, that's definitely negative. But in the Trump wins and it only takes a week or however long, is that a sell the news, or do you think that's a buy?
So there's like the smart guys I talk to, including you guys, but the smart like guys that trade a lot of risk, think sell the news like pretty confidently so. And it's like the opposite of 2016 where everyone freaks out and then Uncle Carl comes in and buys 2 yards of S&P futures and we wake up, the market's actually up a ton. This will be the opposite where, oh yeah, he's great because he's cutting taxes and he's business friendly. So markets are going to go up. But in reality, he said he's going to put out 100% tariffs on China day one, a lot on EU. Yes. He's going to mess with Mexico and Canada as well. Like, S&P is at 22 times end of 2025 EPS projection and very optimistic projections too. Like, is there room, right? For EPS growth and multiple expansions? Yeah, if he cuts corporate taxes, there's some, but we're already at very high multiples and very high optimistic EPS projections in equities, right? So it is at the times. So the only way I see like things that can just have sustainable rallies is sector rotation. But then like banks are at all-time high.
Yeah, banks are definitely anticipating it. But I mean, I think as we've talked about privately, and Nadine have talked about, we're in this working thesis that, if you look at the yen and you look at the euro just being straight down for the last month, right, as Trump's risen in the polls and rates have gone up, like you said, the DXY has had a 4% move. So if he wins, and he can do tariffs day one, so he can be in the tariff game January 22nd or whatever the date is, and the tax cuts will take a little time, so they would be delayed, and then you get the dollar up, could be going back to 120, right? And Europe's got some growth situations, so they might have to not keep that thing as elevated as they have for the last bit, doing the QT and like kind of pretending to keep the rates up. And so you could see a scenario where, like, if the dollar rips, that's bad for risk assets. And that would be maybe one of the ways that they could lower rates domestically, because, that basically is the equivalent of a rate hike globally, the tariffs, and that you could domestically then cut rates to offset, like to have a neutral dollar in essence. What do you think of that?
Yeah, that's totally. And there's incentives for him in the second term to like just do the worst things first, because he can blame it on Biden and be like, it's from the last administration.
Gotta fix
and
it.
Then, so year one's going to be bad, but then year 2, 3, 4 are going to be good because everything's in place, tax cuts in place, tariffs in place. And then the market always adjusts to that. So then people will learn how to live under those conditions, do business under those conditions. But first year, take it back. that's what a lot of smart guys that I talk to are saying as well. And to your point, the mismatch of all that, and then obviously it depends on if Republicans take both the Senate and the House, but obviously, if it's a very split, administration between the White House and Congress, then a lot of these may not be able to go into place, especially if he doesn't have the House or even the Senate. I think they have the Senate in the bag, but you never know. But like, if he doesn't, let's say he doesn't, he can't really cut taxes.
Right.
But his tariff policies can be done through executive orders. So like, there's a lot of nuances as well behind that. But like, yeah, like higher dollar, Fed can't cut, so dollars get stronger. Yeah, it could be bad for risk assets. It's seldom use, and then a lot of people that look at market cycles think that 2025 Q1 is when that market cycle turns.
It's a great kind of take that, and we've talked about gold, we've talked about dollar relative to the election. What about crypto? So when you look at the various potential likely outcomes here in the election, whether it's a quick win by somebody or a delayed, so that's kind of like the first element, and secondarily Kamala versus Trump, how do you think about crypto since you run a fund?
Yeah, so I think people out on I don't know if it's just crypto Twitter or overall sentiment is that crypto's underperforming. It is on like a short time frame, but on the longer time frame, Bitcoin's still
Sure.
a lot.
They might be the people who bought the highs. It depends when you bought in, right?
Exactly. And because the returns were all front loaded at the beginning of this year due to the ETF approval.
Right.
So everyone rushed in, we went as high as 74,000. The reason why we're not there is because everyone bought at the highs.
Right.
And I think the average ETF purchase for the Bitcoins, something like 69, 70,000.
Okay.
That's why we keep hitting that and then we just come off because in reality,
they were already there.
Yeah. The way I look at crypto is it's excess liquidity. And so, it's format of excess liquidity. And that's why we have, and then within crypto, there's different tranches of liquidity where meme coins are at the very bottom, but you can see the froth and the FOMO and the excess liquidity in meme coins. But the way I think about crypto is you need either new money or new narrative to reach new highs. And right now, there's no new money coming in because.
Well, what about the option? They just passed the option, so you could get some through leverage there, right?
Right. So that's a narrative that you can argue is a new narrative. Option IBIT and various other ETFs will be helpful, but you already had CME options for a long time. You already had BitSell options, which is the futures ETF. You had options on that ETF for some time. So I think options on IBIT will create more vol initially, but and it could help the overall ecosystem because it could spur lending in the crypto ecosystem. Like if you have an option, if you were to post your Bitcoin to me and I lend you money, right now, it's like, I think that's relatively safe, but if the lender can buy a put option to protect the gap risk, then, you'll spur more money velocity in crypto. So that's a narrative to your point, I think that could be helpful in the long term. The other narrative is obviously who gets elected. Trump is for crypto. He's for a lot of things, right? So you don't know for sure if he's going to go through
when he's going to do it, right?
Right. With that said, JD Vance somehow owns Bitcoin in his Coinbase account, as he disclosed, and he's argued many times for lax regulation, and he's very much against Gary Gensler. So I think overall, look, Trump just issued, an altcoin. Like he literally just did an ICO. So like, I think they'll just fire Gary Gensler, which is like, who's been like sort of preventing
gatekeeper,
right? I know
Yeah.
you have Microsoft
Overlord.
thinking of getting crypto, right? So I think you have a lot of tech companies probably already know where this is headed. If that election goes Trump ways, and they're thinking what else to do. But what happens with so that I think people know that he's for it or his team is. But what about Kamala?
Yeah, and you know, and to that point, you know, like crypto as a form of digital gold also will benefit if you know deficit spending gets really crazy, and that's the most basic libertarian view of crypto, right? But in terms of Kamala, you know, she's been trying to garner votes from the crypto community as well, so she's promised like reforms as well. She supports innovative industries such as crypto, AI, etc. In reality, I don't think she's really going to do much,
Right.
but she might fire Gensler too, because her biggest donors have urged her to fire Gensler and Lena Khan, who just had a big victory last week on Tapestry, which destroyed a lot of people.
I know that's
I know a lot of guys were
Tapestry,
very
right?
long.
Yes.
So, you know, I think if Kamala wins, Bitcoin goes to 50K, 55,
Okay.
you buy it.
Right there.
Um, so, and in terms of Trump, you know, it could go up first and then sell the niche just like equities.
Right.
So we'll see. Yeah.
And what about you know, when we first met, we were talking about micro strategy. We got connected by our friend Larry McDonald. And what do you think's going on there? I mean, you know, I had that trade on and it worked, and I kind of like got out of a lot of it when MicroStrategy stood up. But like, how about this move there? I mean, that is Saylor trying to corner the Bitcoin market? Is he the smartest guy in the room?
Yeah. So that's the most interesting trade right now, actually. And if I had the mandate and the capital, I would trade that all day, and have a real position on. It's definitely very volatile to stomach.
There's a lot. Yeah.
You know, our model says it's actually at 400% premium.
Wow.
So that's 5 times book. It's just ridiculously overvalued versus its underlying, because the company only owns Bitcoins and has a IT consulting business that generates.
Yeah, it's
That's
a $1.5
probably worth
billion max.
$1 billion.
Right?
Dollars,
Yeah.
Right.
Yeah.
Well, for a 50 billion market cap company, they own about 17 billion Bitcoins. But you have to subtract the debt that they, you know,
Heard to
the money
buy
that
it.
they
Right.
borrowed. It's a
And
bunch of
taxes if you're
converts,
going to sell it.
tax
People don't get
liabilities.
to do that as well.
Right. We modeled for tax liabilities as well, which is about $1 billion. And then, they also have these stock dilutions. It's like very secretive, but you can see on the share count. But basically, you know, they do the ATMs to
All the
issue
time.
new shares, but Sailor also gets a lot of stock rewards because stocks has performed so well. So the question becomes like, who's buying MicroStrategy? Like, who's buying it at 5 times book?
Who's the
And
incremental?
because you can buy IBIT now, right? You don't have the excuse that you can't buy CME futures, you can't buy spot Bitcoin on Coinbase, you can't buy ETFs. Even Bitsub ETF was trading at the time with a negative slide, but now you have IBIT. So if you want to own crypto, you can buy IBIT. You don't need to buy MicroStrategy. So who's paying that? And while the company is selling, right? They're doing the ATM, which is directly selling stock. And they're doing converts, which is both selling a delta of the stock and selling vol on the stock.
Mm-hmm.
And Saylor selling his original holdings as well as new holdings, new stock awards. So the company selling, the CEO selling, it's 5 times book. And they will keep doing it until the premium closes, right? So I don't know. I've pinged a lot of sell-side market makers on who the hell's buying all these MicroStrategy shares. And no one has a real clear answer. The short interest is not very high. It's about 15% short interest, but and that's, you know, that's 15% on 50 billion market cap is about, you know, 7.5 billion shorts. 5-6 billion is the convert hedge. So it's not a real short. It's just hedging the convert. no one's really shorted. I mean, you can say there's probably some funds that like had it and maybe lost money, got blown out, had to cover it and move the spread as a result of blowing out of the trade. You see it in options. Option OY doesn't say that there's like GME type of call activity on MicroStrategy. The skew is inverted by somewhat inverted. It's not like to a point like gold even. It's not as inverted as gold. So it's not options. And then I guess you look at HDS, the holders on Bloomberg who owns MicroStrategy. It's a lot of, and I wonder why. And I pinged some of them. I have contacts to zero use. Right? Well, Risk Capital Group is number one shareholder. Then you have Vanguard as a second shareholder. But it's the structure of equity markets where, these real money they own almost every stock. And so, and then they're lazy longs that they don't say, oh, this is 5 times book. Let me just rotate it. But I don't think they're buying and then there's the new 2 times MSTR ETF that's now 800 million market cap, 800 million.
It's huge. Yeah.
Maybe that's part of that's like kind of like call option activity in the sense that they have to buy more as it goes up.
It's like a $300 asset, right?
Yeah, and that has options that trade on it.
That's insane.
Which is crazy.
That's insane.
So then that might be it. But then on down days, I don't see it really down that much. Like you don't see the same beta on the downside. So maybe because they're in blackout, they can't do more ATM or they can't issue more converts right now, that there's no supply. And so people are just pushing, right? They're trying to push it such that the funds that put on this trade at 200% premium, 300% premium are now like, we literally lost 100% on a ARB and we had to blow it out. And we don't want the spaces into election. And therefore we're going to blow out.
Yeah. Yeah, and that makes sense, actually.
So I think after election.
Yeah. One more question on crypto. What's going on with, if you go back to 22 into the merge, and I was pretty involved with Ethereum back then, and there was this like grand bull thesis for Ethereum. But if you look at the XBT, XET, so Bitcoin divided by Ethereum, it's been just an awful bear market in that. What's going on there?
Yeah, so 2 things. One, it's not that bad for ETH on an absolute basis. $2,500 and ETH is quite an accomplishment for ETH people. Since the ICO was less than $1, it's off from the highs of this year and all-time highs. I think all-time is about 46, and this year's high is about 4,000. And so Bitcoin is near the highs, but ETH is way down, and that's because of a couple things. One is, I think the layer 2s take a lot of market cap away from ETH now that a lot of activities are on layer 2s. And then you have like all these new layer 2s that come out every day. And there's no like a consensus direction for where ETH is going. What does it want to be? And the leaders of ETH, like all the guys from the foundations, don't really care anymore because they're rich and they like retired. So there's no real direction for the one. And then you have competitors like Solana that, for better or for worse, are generating more activities on chain than ETH right now. Now, it's all meme activities. Guys just trading on this thing called pump.fun, where you create a token and you try to like pump it and like hit the lotto. But in reality, most of those people lose money. It's a cabal of insiders that really make money in the end. That's generating all the activities on Solana. But just on a pure metric, people can look at it and say, oh, this is not doing so well. There's no one using it as much. All the activities happens on L2s. L2s, I think at one point a couple months ago, in aggregate, 100 billion market cap. So it's probably like 60, 70, if I have to guess now. I didn't really run the numbers, but that's in itself a huge market cap. And then on top of that, a lot of these Ethereum applications that were built on Ethereum that tokenized were VC tokens, meaning there's negative connotations of VC tokens because they're like VC bags, and there's like a whole system where they have very low float, high FTV when these tokenize, meaning they IPO'd, and then the VCs have the pressure to monetize, and they should, because some of these are 100x. So Arbitrum is a perfect example of Ethereum L2 that is a big VC bag, and these firms are selling every day as they unlock. And that's sort of left a bad taste in a lot of the people's mouth, because, Arbitrum's down like 70%, 80% max. So that's kind of like what is, it needs new narrative, it needs new use case. And of course, because it was the second highest market cap L2, L1, that other L1s are trying to go headhunt, Ethereum for market share.
Well, Tian, we're going to have to get you back on the podcast soon to check on markets, what's ensued post-election, talking credit spreads, crypto, gold, dollar, capital markets, convexity, lots of C's in there, cash, I'm going to call it. So thank you so much for sharing your wisdom on all those topics with us today and our subscribers. So if listeners want to connect with you or hear more about your work, where can they find you? How do they connect with you?
Yeah, so I would say maybe just my email, just tzeng@nirvana-camp.com.
Okay.
I have a Twitter, but I'm anonymous.
Okay.
Maybe
I'll give you
go. Yeah,
You go public
maybe
at some point.
maybe I will. I was public during COVID at one point, but then I had to go anonymous for a lot of reasons. But happy to chat about markets and connect with everybody.
Awesome. Thank you so much.
Thanks
For
buddy.
having me. Yeah. Talk soon. Bye.